Okay, the biggest question would be, what is economics? You have to know what is economics, because of economics is one subject which you cannot do in isolation. By that I mean, it's not like accounting. Accounting, you can know income statement but not know balance sheet, right? Or statement of financial position. Or you can know statement of financial position but not know income statement and really excel. With economics, you can get away with it, but it's very, very, very difficult and very, very unlikely that you will get away with it. So by that I mean, it's a module that you'll have to learn from the ground up going up. Right, from the ground going up. That's economics for you. So if you'll be doing ECO10B, you will have to remember some of the things from 10A. And if you're doing 10A, you will have to start from the introduction, and you will have to understand terms, right, or key concept or words. Okay, you have to understand terms or key concepts or words. So this is why you have to understand words, because they will ask you questions using that language, and throughout the semester that will happen time and time again. You will learn a word such as autonomous spending. This is not just a regular word that you use in your conversation with your friends, right? You don't be saying things like, yeah, I had autonomous spending, right? So you have to know what it means. You'll see words such as multiplier and all those things. So understanding them is very important. Okay? But for this session, we will keep everything as simple as possible. So some of the things I will not explain in detail, because the only way I can do that is if we start this from the introduction truly and fully. But let me just simplify this economics for you. Okay, so we have two types, right? You have micro and then you have macro. Okay, we have micro and then you have macro. So usually micro, it's your 15A or your 10A. Not usually, all the time. And then your macro is 15B and then 10B. Okay, so in micro, remember the word micro refers to something small, right? I think even there was a time we used to have a micro sim, which is the smaller one. Now I think we have nano, right? So micro refers to something small. So under micro, you'll be focusing on individual parts of economy. Right, you'll be focusing on individual parts of economy. So by individual parts of economy, you'll be focusing on things such as households, right? You'll focus on firms. So by households, it's you guys, your salaries, are you working, what do you prefer, and all those things. And then firms, you'll focus on maybe one industry like food industry, or you'll focus on gas industry, or you'll focus on manufacturing cars, stuff like that. And then you'll also focus on prices of goods or changes in prices of those goods or products or services, right? That is micro. You just focus on small parts. That's where you'll find yourself calculating the demand or the supply of maybe cars or food or something like that, right? Then you move to macro. So macro, you look at the whole economy. You don't look at small parts of economy, you look at the whole economy. So when you look at the whole economy, you look at things such as inflation. Remember, inflation does not care if you're black or you're white or you're Indian or you're gray or green, right? It affects you. But micro can actually miss you, right? If the rates are going up, usually they'll affect people that have loans and stuff like that. Someone that does not have loan, that stays maybe in the townships and does not engage in such, they won't be affected. They don't care. But inflation, that's macro. It affects every single person, right? And then you look at also things such as unemployment. So unemployment does not necessarily focus on people that are unemployed, because remember, when you say unemployment is 50%, you are indirectly saying 50% are employed, right? So unemployment also indirectly involves the employed, okay? And then also the economic growth, that's what you'll focus on. You'll focus on the imports, you'll focus on the exports, and many more, right? This is macro. So this means, now that you know the difference, when you pick up a question paper and you see inflation or you see unemployment, you know this is 15B or 10B. And then when you pick up a question paper and you see a question that says calculate the demand for tomatoes or apples or bananas or whatever, you know, here I'm dealing with micro. All right. So just understanding this small information is very, very, very key, even when you approach this module, which is economics. Very, very important. All right. But like I said, economics is not a module that you can do in isolation. You really have to start from the ground and then go up. And that's what we're going to be doing throughout the semester. Now, let's look at this question. All right, so I'm going to read this question and then I'll ask if this falls under micro or macro. Right, so remember guys, you're here to learn. So if you get something wrong or if you're not sure, that is part of the process. Please, let's not be scared of getting things wrong or not knowing, especially when you are learning. You can only have fears maybe when you're writing exam, because by then you believe that you've prepared, you've done all that you can, so you can't have those fears. But for now, you really have to be free. All right, and you don't have to write anything down, by the way, because you'll get these notes in the videos. So there's a scenario here which says Africa Academics, a company that offers online lessons of financial management, is interested in analyzing the market for online lessons of economics. Right, they want to analyze the market for online lessons of economics. Already they are offering financial management, but now they are interested, right, in going into the economics, so they are busy analyzing. So the research department, which was doing this analysis, the research department collected the following information about or for demand and supply of online lessons for economics. Remember guys, when you go into business, it does not matter if you're going to small spaza shop or whatever, but when you go into business, you really have to do your research. And some of you, maybe if you have attended my lessons before, maybe you know that usually after a semester or before semester, I will ask questions about services and other things, your interests, how you experience your studies, and all of those things, right? That's part of the research. Okay, that's what we mean by research. You talk to potential clients or your clients, and then you come up with information, right? So it's the same thing that is happening here. The research department collected the following information for demand and supply for economics. All right, so they have there a table. The first column is price of lessons, all right, per lesson. So it's R and then slash lesson. That's per lesson. Okay, so these lessons, Africa Academics is considering charging 50 Rand per lesson, 100 Rands per lesson, 150 per lesson, 200 per lesson, 250 per lesson. Right? So when they are considering those prices, they went to Grace, Chau, and Sepo, and then they asked these questions. Right? So they said, hey Grace, please, can you just give me your honest opinion? How would you feel if I charged you 50 rands per lesson? Then Grace said, I'll feel okay. I'll even attend 9 lessons per week, right? And then we then increased the price. We said, well, how about 100 rands? And then they said, well, now it's a bit expensive, but I'll still attend, so I will maybe take 7 this time. Then we increased the price further and further until we reached 250. And then Grace said, I think this time I'll just only stick to 2. All right. And then Jebu also gave his opinion, and then ended up saying, no, at 250 I won't afford, so I won't attend anything. And Sapo said at 250 I'll only just take 1 lesson. Okay, that's part of research, right? So after doing all of that, we then got a total number of lessons demanded per week. This is demand, by the way. You can even hear by the word demanded. So here we're talking about demand. We're not talking about supply. I'll just explain right now what demand is. So we get a total of these people. Of course, there can be more, but when you do research, and you will see also in your MET 101, they will say that you should have a sample. I mean, you must focus on just a small portion, because you cannot do research every single person, right? It's impossible. So we find that we can get people ordering 22 lessons at that price, and then eventually 3 lessons at that price. Okay, so just to explain what demand is, this is very important to understand, right? So demand is not people liking your services or wanting your services. That is not demand. Just because there's 500 students that want to attend with Mr. Aldoa does not mean there's 500 units of demand, right? Demand only exists if people can afford. So if someone can afford something, then there is demand. This is me just simplifying it for you, but you'll find the definition in your textbook about demand, right? Demand is backed by the power of purchasing. If someone has money, then we say that there is demand. But if someone does not have money, there is no demand. That's just needs and wants, right? Then supply also will be from the supply. Of course, in this case will be Mr. Aldoa supplying lessons. If Mr. Aldoa does have the means to supply these lessons, it means there is a supply of lessons, right? But if I'm just somewhere, I don't have a computer, I don't have microphones, I don't have anything, I don't have the knowledge, then there's no such thing as supply, right? So there's a question that says, answer the following questions. The owner of Africa Academics, Mr. Aldoa, does not understand the information above. This is the information we are referring to, and has asked that you use demand curve to illustrate the information above. So this information is a bit confusing for this guy here, Mr. Aldoa. So he tells one of the employees, which is you know economics, and he says, can you please just use a diagram, demand curve, maybe to illustrate this information? Maybe it will make sense to me, because when I look at this, it's a bit confusing, right? And then you say, yes, I will help you. So just before we use a demand curve to illustrate the information above, can you guys please tell me if this falls under micro or macroeconomics? Anyone, you can use a chat box or you can use a microphone if you think this falls under micro or macroeconomics, depending on what we just discussed. Anyone? So no one, or you guys did not hear the question. Should I repeat the question, or no one is confident enough? All right, seems like no one is answering. Okay, so this falls under micro, right? Because the focus is on small parts of the economy, right? This is not something that will affect other people. Other people won't be affected by the lessons which Africa Academics is offering. So that's why this will be under micro, unlike when we talk about macro, whereby you look at the inflation, unemployment, economic growth, imports, and then exports. All right. So this one will definitely fall under micro. So let's continue to answer this question. So remember, we have to illustrate this using a demand curve. Okay. So you're going to draw a diagram. This is something that you're going to see often. Something like this. Okay. I haven't checked your assignment yet, so maybe this might help you somewhere. You'll just check. So I haven't really checked. Okay. All right. So there's a difference, by the way, between a demand curve and a supply curve, right? So you'll see something like this often. Yeah, you see a line going up, and then you'll see a line going down. So usually here you'll have the quantity. You'll see a Q, meaning this is a quantity. And then over here you'll see a P, which stands for price. All right. So the law of demand and supply, they are very straightforward. And this is something that will be proven by these results here, that when things become more expensive, people want less and less of those things. All right. When things become more expensive, people want less and less of those things. So obviously here we'll start with 0. All right. And then we can say from 0 we go to, let's say, 50, and then 100, and then 150, and then 200, and then 250. Okay. And then in terms of quantity, we'll go from 3 to 22. So we can use 246, I think it's possible, or 5, 0, 5, 10, 15, 20, 25. Okay, just like that. So we will take that information that we have from the table, and then we will show it over here. So these are the amounts that we took to come up with the scale for the price. You can see, and then this will be the totals that we use. All right. So the first one will be 50 rand. So if lessons are going to cost 50 rands, then only 22 lessons will be demanded. So you'll go from 50, and then you'll draw a horizontal dotted line, and then you'll come to 22. I think 22 somewhere there. All right. So we'll have a dot, and then we'll go to 100 rands. If lessons are costing 100 rands, we'll only have 17 demanded. All right. So you'll have dotted line over here, and then over here you'll have the 17. All right. And then 150 is going to be 12. So I'm sure by now we can all see the trend. So you'll have 150 going somewhere there. I think 12 is there, or maybe not. And then we'll have 200 with 6. Okay, 6 can be somewhere here. and then finally we'll have 250 with only 3. Okay, so when you connect those lines, you will have your demand curve. Okay, so you'll just name this to say this is my demand curve. So this is telling us that as the price goes up, the quantity will decline, right? But as the price go down, and then people will want to buy more. So next time you find a question during the exam or assignment, it says draw a demand curve, it will look like this, right? As easy as this. So do we have any question about this before we move to the next thing? Okay, perfect. So we now move to the next question, which is also still under micro, right? The question says Africa Academics is already planning for 2024 pricing for their products and services. Okay, so the research department presented the following supply and demand equations for online lessons of economic services. So besides using these diagrams here, the one that we just use here, or this information, you can also use equations, right? So equation just saves you time from drawing these lines and then this table here. You can easily enter a price there, and then you will know how many people would demand that product or that service. Okay, for example, let's take this equation here. Okay, so it's written QD. So QD simply means quantity demanded. The D means demanded, right? Q means quantity. Okay, so you'll say 4,800 minus 0,2, and then P. So P simply means price. Okay, so let me just write here. This is quantity, and then D means demanded, and then P means price. Okay, so in place of price, you'll choose any price, right? So let's say Africa Academics decides they will charge for their lessons, they will charge let's say 90 rand. Okay, so you'll just punch this on your calculator. You'll say 4,800 minus 0,2 times 90. Right, and this gives me 4,782. So this means if you charge, or if we charge 90 rands, this is the number of lessons people will demand. Right, this includes all people. It's not only just a single person. So let's see what would happen if we then increase the price. Let's say we make it 100 rands. So if we make it 100 rands, the price will then become 4,780. So we can see that it decreased. I mean to say that the quantity demanded decreased from 4,782 to 4,780. So you can see that as the price increase, less people demand the services, right? So now, because of we have this equation, and with this equation we can know how many people will want our lessons. Each and every business wants to get the most it can. By the most, I mean you want to get the most clients and also make the most money. So how can you do that? Well, you will do that by equating the quantity demanded equation with the quantity supplied equation. This simply means that we won't have more than people want, and we also won't have less than people want, because this is something that can happen. Imagine you have a neighborhood or a township, right? And then there's only one spaza shop. That spaza shop buys 100 loaves, but people every day they only buy 70. So it means 30 loaves they go to waste every day, right? So this business would be stressed thinking, well, what is the correct amount? Because some days when we buy 70 loaves, we have people wanting 100 loaves, and then we lose money because of you could have sold 30 more, right? So we have what we call equilibrium. So equilibrium simply means you have equal supply and demand. So to find the equilibrium, you will simply equate your quantity demanded with your quantity supplied. All right, so you'll take this, you'll say equal this. So you'll say 4,800 minus 0.2 p is equals to 3,600 plus 0.4 p. So here you're going to need a little bit of mathematics background to be able to understand this. This is an equation and it has to balance. So the way to balance this, you just take numbers one side. So here you'll see you have this is not the right color. So here you see we have 4,800. Here we have 3,600, right? Those are numbers. The other numbers, they have a p, so we can't really call them normal numbers, but they are numbers as well, but just not normal, right? I'm referring to this. All right, so we'll just take the yellow colors to the left side. So you'll have 4,800, and then that 3,600 will come to the left side. So you'll realize that it changed the sign, right? There's a negative there, and then you'll say equals to, and then this 0.2 p will come this side. So you can see now we have our p's on the left side, on the right side, and then our numbers on the left side, right? So that's what we mean by balancing an equation, but we're not done yet. That's just a part of it. So 4,800 minus 3,600, that gives us 1,200, and then 0.2 p plus 0.4 p, that will give us 0.6 p. So the next thing that we will do here is we will isolate the p. So we isolate the p by dividing both sides by 0.6. So let me just show on the side what is actually happening. So we have 1,200 being equals to 0.6 p. So you'll just divide both sides like this, and then obviously this will cancel this. You'll be left with p, and then 1,200 divided by 0.6, this side will be 2,000. Okay, so the equilibrium price in this case is 2,000. So we must charge 2,000 for our lessons in order to match the demand, and also the supply. I mean, say in order for the supply to match the demand, right? We have to charge that price, right? You can even test if your answer is correct by substituting in both equations. So you can say QD is equals to 4,800 minus 0.2, then in place of P you put 2,000. So this should give us 4,400. So if you do the same thing for QS, and then you say 3,600 plus 0.4, in place of P you put 2,000. It'll give us also 4,400. So that's how you calculate the equilibrium price, right? If a question comes and say calculate the equilibrium price, that's how you do. This is the equilibrium price, this P here. So remember guys, if this is new to you, like I said at the beginning, you should really be patient with yourself, because you're just here to learn, right? Some of these things, they will really sound confusing or sound like it's difficult to understand, but they're totally not. For a first time, definitely will be confusing, but after watching this video 4 times or 5 times, then definitely you will get what is happening. All right, and like I said, if there's any question, you can ask. If there's nothing, then we will move to the next question. So this will be the last question for the night. And this question here is actually dealing with the macroeconomics, which is your ECO10B or 15B, right? And if you still remember from the discussion we had earlier on, was that macro will focus on inflation, unemployment, economic growth, imports and exports. Basically, you're looking at the overall of the economy, the total income, total production, and so on. So this question here is from the past assignment or question paper, I don't remember, but yeah, it's one of the question papers. It says use Keynesian model to answer the following questions. Okay, so this means you have to understand what Keynesian model is in order to be able to answer this, but you can still answer without knowing what Keynesian model is. But like I said, economics, you really have to understand the basics, right? So I'll just explain in short what Keynesian model is. So Keynesian model, this is a tool that economists, they use it to determine the total production in the economy, right? If we want to know how much South Africa has produced, we will look at the Keynesian model. If you want to know how much total income was there of the economy, you look at the Keynesian model, right? It will give you all of that information about the economy, right? And then, but in this module, you will have some assumptions. So these assumptions, they help us to not really question this model, because if you look at it, you can question it. But when this assumption, remember, assumption simply says, well, we are going to learn, how can I say it? You can say, well, we are going to learn how to run, right? But we'll only run for 5 or 10 meters. So if you do not say people were running for 5 to 10 meters, you might say to yourself, but there's no way these people ran, because the time only says these people were running for 2 minutes or 1 minute, right? But when you say these people ran for 5 or 10 meters, then you can understand why the running time was so short. So even in this case, you will need some assumptions. We cannot discuss the assumptions right now because we don't have enough time. So I'll just do the calculations and hopefully you will understand them. Okay, so the first thing that we're going to do here, it says, what is the value of the marginal propensity to consume in this model? Usually you will see this being written as MPC. Okay, we have to learn how to calculate MPC, or the marginal propensity to consume, right? Also, this one I would have explained it in detail if we had a normal session, right? But we only have 1 hour, so we have to do the calculation. But just to explain in short, before we even start here you will see we have C. All right, so this C is consumption. It's showing us how much consumption was there in the economy. And then here we have I. So I is showing us how much investment spending was there in the economy. And then over here we have G. So G is showing us the government spending. All right, so this is very important information in this topic here. All right, so we have consumption, and then we have investment, and then we have government spending. And then next up here we have the tax rate. All right, so that small t is your tax rate, and then we have capital letter T. So T is showing us how much was the tax, right? You can just say how much. And then there we have YF, that is the income at full employment. So like I said, you cannot really understand this in isolation. So some of these things you'll learn them along the way. So let's start with the first one. What is MPC, or marginal propensity to consume, right? So the MPC is your C, which is this one over here. We have this C. So just like that, when you see a C, just know that that's your marginal propensity to consume. You don't have to calculate this one. 0.875. That is our marginal propensity to consume. And then number 2, it says calculate the multiplier. So the multiplier is the one which you have to calculate. And there's a formula for that. You'll have 1 over, and then over here you'll have 1 minus C, then in bracket 1 minus small t. Okay, this is where you will substitute. You will have 1 over 1 minus the C, which is the one that we have over here is given to us, 0.875, and then you open a bracket, 1 minus the small t over here, 0.143. All right, like that. So you can see that the information is given to you, right? There's really no reason why you should not get this, because the information is given to you. However, you can see that you should know which formula to use, right? You should know which formula to use from your understanding. So if you do have a calculator, hopefully you do use a Casio, then this should be straightforward. The very same way that I wrote this is how it will appear on your calculator if you're using a Casio. So you can calculate this if you do have it. If you don't have it, you'll calculate it in your own spare time watching the video. Okay, so I got 3.99, which when I round off is 4, right? So you can just write 4, but initially you'll get 3.99. Then after rounding off, you will get a 4. So that is the multiplier. That is how we calculate it. Remember guys, if there is a question, you will ask. Okay, so far we have done the marginal propensity to consume. We've also calculated the multiplier. The next thing that we will calculate is the equilibrium level of income using the multiplier value. So we'll use this 4 over here. Okay, so I'll just remove this. Okay, so the formula for calculating equilibrium level of income is Y, that small o there, and then you'll have this times A. Okay, so remember this is the multiplier that we calculated, right? And then our A here is our aggregate spending. It simply means aggregate spending. Okay, so our aggregate spending is equals to C, which is consumption, and then I, which is investment, and then also G, which is the government spending. I did explain them over here. Okay, and then the amounts are given to us over here. We have 20 million, 300 million, 180 million. All right, and then our multiplier we did calculate, it was 4. So you'll simply come here, you'll substitute, you will say 4 times, so open your bracket, and then your A, right? I did explain now that A is the total of those. So you'll have your C at 20 million, you'll only write 20 plus the I, which is 300 million, plus 180 million, which is 180. Okay, so 40 times, you can just get a total of that. Let's say 20 plus 300 plus 180. That is going to be 500. So 500 times 4 will give us 2000. So that means the answer is actually 2000 million, because remember we are dealing with millions here. The numbers are written there, millions, right? So that's how we know that that is going to be a million. So that means the equilibrium income is 2000 million. Okay, so I also feel like this one is straightforward once you know the formula. So the next question then says, how much does the government collect in taxes? So remember I did say that the big T, which is this T, is going to give us the amount of the taxes, right? So how much does the government collect in taxes? You'll simply have your big T or capital letter T, and then you'll say 0,143 times Y. Okay, 0,143. And then what is our Y? The Y is the one that we calculated just now. And then we got 2000 million. Okay, so I'm just reminding you, but you don't have to write the 2000 million. You can only just write the 2 million there. It'll be fine, just like that. So you'll say 0,143 times 2000, right? And then you'll have 286 million. That is how much tax the government has collected, because remember the government collects tax from people's incomes, right? Hence we had to use the equilibrium income and then the tax rate. That's how we got the tax. Okay, and then the next question says, is the government currently running a surplus or deficit? So what does this even mean? So remember, a government has a budget, right? And then from their budget they have spending. So the budget comes from taxes. The money that the government uses to build roads or fund education or pay grants and other things, it comes from taxes. So that means the tax amount always has to be more than what the government is spending. If the government is spending more than the government, then the tax, then they definitely have a negative in their accounts. So when there's a surplus, it means there is more, there is extra, right? And then when there's a deficit, it means there is less. All right, there's actually a negative. So that's what the question is asking us. The question is asking us, does the government have more money or does the government have a negative balance? Okay, so the way to go about that, you will simply say, right, the number 5, we can say the balance, or B, is equals to the tax minus G, which is government spending. Okay, so the tax that the government has collected is the one here, which is 286 million. The government spending is the one over here, which is 180 million. Okay, so you'll say 286 minus 180, they are left with 106 million. So the government has a surplus. Okay, the government has spent 180, they are left with 106 million. So there is a surplus. So that's what the question is asking. Is the government currently running a surplus or a deficit? That's how you calculate that. Then the last question for the night says, approximately how much must the government spending be raised to achieve full employment? Full employment is this. All right, for everyone to be employed, then this must be the income, 2,400 million. So now the question is, how much must the government spend to actually reach that target? So This one is also straightforward. The formula is not as complicated. Okay, so first thing that you will do is you will have your formula there, the income at full employment minus the equilibrium income, and then you will have the gap. Okay, so the income at full employment is the one given to us over there as 2,400 million, but here you'll only write the 2,400, then you'll minus the equilibrium income. This is the one that we calculated at first, and then we got 2,000, if you still remember, and then we will know the gap. So we'll say 2,400 minus 2,000, and this will give us 4,000, which is the gap. Remember, this is 400 million. Okay, so we will take this amount over here, and then we will divide it with the multiplier. And then our multiplier is what? Our multiplier, when we calculated it, it was 4. Maybe you did forget because of I did erase them there. So you'll say 400 million divided by the multiplier, which is 4, and this will give us 100 million. So the government spending must be raised by 100 million in order to reach full employment. So it means 180 plus 100 million, and then the government will have full employment. So if the government spends 280 million, they will have full employment. And that is about macroeconomics 10B 15B. So do we have any questions, guys? Or there is none? All right, so yes, I did expect no question because this is still new. So I will share the notes and the videos tomorrow. I think tomorrow I'll share them in the groups. So if there's no question, guys, then this is a good night for me, and thank you very much for joining. Anything else we will discuss in the inbox. Thank you. Bye.